Good afternoon, everyone. I am C. Raja Murdhwa Sharma, Vice Chairman, Jaipur Branch, the moderator of this webinar. We are delighted to welcome you all to this webinar as continuing Professional Education Committee of ICI. It is my pleasure to be a moderator for the 94th webinar on recent updates in GST and amendments in income tax from 4 p.m. to 6 p.m. In a short while, we will start this webinar. First, I would like to apprise you about the CPE committee. In today's ever-changing professional scenario worldwide, the biggest challenge the professionals face is how to stay on the top of their game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspective in this context. CP committee facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinars and seminars. The program for this evening as follows. We have two sessions for 1 hour each, and the first topic is recent updates in GST, and second topic is recent amendments in income tax. For first session, recent updates in GST, we have our speaker CA Devendra Kataria ji from Kota, Rajasthan. He has more than 14 years of professional practice serving clients in the areas of compliance, consultancy, and litigation. His core area of expertise in GST, where he provides comprehensive advisory and representation services. He is registered faculty of GST with ICI and actively contributes to professional education initiatives. He has delivered over 100 lectures and seminars on GST for various professionals and business associations. Now, I would like to invite CA Devendra Kataria sir for deliberation of his session.
Thank you, Madhurji. Thank you so much for reading out my introduction. And before actually starting, I would like to express my gratitude to the CPE committee, the chairman, vice chairman, the entire team for considering me worthy for presenting my views on the topic. As you all know, GST is a ever changing subject, and new things keep coming up, and it's our job to basically keep studying it. And in from my role, I mean the entire chartered accountants profession. It's our responsibility to keep ourselves updated and give proper consultancy to our clients. And with this remark, let's start today's session. I would also like to invite my co-speaker, C. Anubhatia ji from Jaipur. Welcome, sir.
Thank you, Devenji.
Thank you, sir. Thank you, sir. Let me share my screen and then we can start the presentation.
Yes.
My screen is visible, sir?
Right. It's visible, sir.
Okay. Thank you, sir. Let's start. So basically, today's topic, which has been handed over to me, is regarding the recent updates in GST. And we talk about updates. It's not just amendments; it's the updates. So updates can be of various types. First, obviously, we'll be talking about the latest amendments, which have been incorporated by way of change in rules, or new notifications have come up, or there are certain changes in the law. Then recently, budget was announced, and we'll talk about certain budget proposals also. I'm still saying proposals because it has not been accepted by the president and it has not been implemented. And lastly, we'll talk about recent judicial developments which have been taking up in the last 2 or 3 months. With this, let's start. The first and foremost, we'll be starting with the latest amendments. Guys, you already you must be knowing that recently for tobacco and tobacco products, there was cess. Like GST 2.0 was implemented from 22nd of September 2025. But still, the rate of GST on tobacco and its products was kept at 28%, despite the entire other slab was removed. Further, compensation cess was also kept intact on tobacco and its products uh, after GST 2.0 implementation also. But now from 1st of February 2026, the slab of 28% and the compensation cess has been entirely removed. Now, no product is there in the category of 28% or any cess is applicable on it. So now the valuation perspective also for the tobacco and its products has changed. The rate of tax has changed. Cess is removed. So in a way, the entire industry is going through a change, and let's see what all changes the entire industry is facing. The first and foremost change, my dear friends, is like we are in a world of moving ahead, like kind of we are moving backward. The MRP based taxation regime was present in excise and also in VAT regime. And when GST was implemented, we were talking about that now MRP based taxation has been abolished and we'll be paying tax on the transaction value. And whatever the person is selling for will be paying tax on that sales value. But my dear friends, MRP based taxation is again being implemented by virtue of change in section 15, wherein section 15(5) specifically, like 15(1) talks about transaction value shall be the value on which tax will be applicable if buyer and seller are not related persons. And secondly, that the price is the sole consideration for the transaction. But 15(5) gives a residuary power, notwithstanding over 1 and 2, that the government shall have the power to notify certain products or certain supplies on which valuation shall be calculated as per whatever has been prescribed in the rules. So by using that power, section 15(5), the statute has delegated its power of legislation by way of notification, and therefore the delegation legislation principles apply. Now we have to be very cautious while studying these topics, because once the power is delegated, the first and foremost test that whether the delegation could happen is that there should be enough power enabled in the law. So we have section 15(5) which gives power to the government that by way of special notification they have power, by way of issuing notification they can delegate legislation and bring some changes to that. So using that 15(5), notification has been issued, wherein notification 19/25 and 20/25 central tax, two notifications have been issued, which are applicable from 1st of February 26. So when you'll be filing return for February 2026, these changes have been already incorporated. And these changes are mainly to pan masala, tobacco, and cigarettes and no other products. Basically, all those products which were part of the 28% slab rate and on which compensation cess was applicable. Because of this cess, uh, the tax amount, including cess, was even higher than what was the actual sales consideration of these products in various cases. But by after this change, cess is removed. Tax rate is 28% is removed. Now it is in same goods 40% category, wherein luxury vehicles are also there. Now, since there is only 40% tax rate and there is no cess, do you think that the taxes will come down on these products? Because this is one area where the government is earning huge revenues from this market. So, to add on this, the government is not going to incur any revenue loss, because once GST has been abolished on these, not GST, but rather compensation cess has been removed from these products. Parallelly, excise duty also has been imposed on these products. So overall, the government is not running short of revenue. Only we people are running more of compliances, and we are again moving backward towards multiple taxation regimes. While in 2017 it was marketed like GST will be the only indirect tax, except for certain few parallel taxation. Now again, excise duty is again being imposed on pan masala, tobacco, and cigarettes. So a person who's dealing in these products have to make compliance with GST, has to make compliance with excise duty as well. So everything has to be go around that. Now, basically, what the valuation has been emphasized on, it is based on the declared retail sale price. Whatever the price is declared on the kits, that will be considered as the basis for valuation, how to calculate tax. Let's discuss these notifications in detail and then we'll move forward. First and foremost, we've already discussed that this is applicable to pan masala, tobacco, and cigarettes. And the interesting point is it talks about multiple retail prices as well. If you come across that a packet has multiple retail prices, say for example, they for area based division for this much area, this will be the maximum retail price, and if we are moving forward to some other area, the retail price may be a little higher. If this situation comes up, then what will be the basis for calculation of taxable value? As expected, the higher rate of all the prices will be considered as a base for calculating the taxable value and tax accordingly. So in case if you come across that multiple retail prices are mentioned on a particular product, higher retail price will be considered for valuation, right? What if there is a change in retail price subsequently? Can there be a situation that the retail price is changed over the period of time? Over the period of time, in the sense, I mean, like from the manufacturer, the products have the commodity has moved. Now it is there in the stock with maybe the distributor or dealer before being ultimately consumed by the consumer. It is within the supply chain. And within the supply chain, the retail price is changed. Changed, maybe it can be reduced or it can be increased. If the retail price is increased, it has to be separately mentioned on the packet. And since the retail price has been increased, it will attract taxation and all the provisions as per the increased retail price. The notification does not speak anything about the reduced price. If the MRP is reduced, like we're talking about change here, but the notification only talks about increase in prices. It does not talks about reduction in retail price. What will happen if the retail price is subsequently reduced? Now, when we talk about Legal Metrology Act, which governs about these retail pricing and labeling provisions, they clearly say that if the price is amended, you have to clearly mention, you do not have to remove the old price, you can simply strike it through so that it can be seen. And you have to separately mention what is the new retail price is. So in a way, the packet will now contain multiple retail prices. Only one of them is applicable. However, in just previous working, we discussed that if there are multiple retail prices, the provisions will be applicable on the higher retail sale price. But if the price is reduced, whether we'll consider it as reduction in our taxable value and we'll be able to issue credit notes or nothing of that sort, the notification is silent on that, and I'm hoping that they may come up with a clarification, or they are to be treated like multiple retail prices. Once you have paid the tax, it's over. So this particular explanation is required to be received. Then if there are different retail prices for different packages, say for example, I have multiple factories from where goods are being dispatched, and from one particular factory I'm dispatching goods with say retail price X, and from another location I'm dispatching with retail price Y, because there may be a difference in my cost and difference in my valuation. So whatever the retail price has been made available on that packet, that retail sale price will be applicable for calculating the tax. See, if I can have multiple retail prices for my multiple products, same product, different location, different packing, different retail sale prices, all available, all uh, uh, can be done. And whatever the retail sale price is mentioned on that particular packet, that supply will attract that taxable value. So it's very clear in this situation. What the next notification 20/25 does, it basically brings out the amendment in rules. A new rule 31D has been introduced. What does it say? Like 19/25 was issued by using the power of section 15(5), that yes, we have the power, and they have notified that all these commodities will be now taxed as per retail sale price, and there they have defined a few terminologies like retail sale price, or what is the multiple, if there are multiple retail sale price, what is to be done. All those things are mentioned in 19/25. But new rule has been introduced by way of notification 20/25. What does the rule say? The rule simply lays down the law. What? The value of supply of goods shall be deemed to be the retail sale price declared on such goods less the amount of tax applicable. Like in simple words, we can say that uh, the retail sale price is going to be inclusive of tax, and uh, what will be the actual valuation, how will be the tax calculated. So they have given a formula for that. Tax applicable will be like what we calculate as per rule 35, and what should be the formula for calculating tax when it is inclusive of, when the value is inclusive of tax. So that exact formula they have given, whatever the rate of tax applicable is there into 1 upon 100 plus applicable tax. Now, when we compare this scenario with the existing regime or the old regime, say for VAT or excise, what used to happen in VAT was once the entire tax has been paid on the first point of tax, the subsequent points where the supply or the taxable event occurred were either exempted or were not required to pay any amount of tax, because the entire tax which could have been paid on this transaction has already been paid on the first instance. But this is GST and this is value added tax. So you get to pay tax on each point. And since the entire tax has already been paid at the first point, the second leg in the supply chain will have 100% ITC, and they will again have the same amount of output, and they will never have to pay any tax in cash. But the rules for input tax credit shall apply as it is. See, if your supplier again has not declared in his GSTR1, you will not get ITC, but you again have to pay tax on the same amount. If your supplier has not paid the tax, I mean, all Section 16(2) conditions are still to be met, even though the entire tax has been paid on the first leg of the transaction itself. Now, when we are saying that the subsequent suppliers will not require pay tax in cash, what will happen with Rule 86B? Rule 86B says that in case if a person has more than 50 lakhs transaction of any taxable goods in a particular month, he has to pay his output tax liability for at least 1% in cash. Or rather, the language is on maximum 99% of ITC can be used for making such a payment. So in that case, what will happen? Because here in this case, since the entire tax is paid on the very first leg, and the subsequent suppliers are not required to make any payment in cash, what will happen to Rule 86B? The answer is here. This very notification brings the change in Rule 86B as well. It says that these transactions will be under the exceptions category from Rule 86B. Rule 86B will not be applicable for these particular transactions only. So if a supplier is engaged in supply of tobacco and pan masala or cigarettes and some other things as well, Rule 86B will be applicable on other commodities and other supplies, and it will not be applicable on the transactions covered by this notification. So these are the two changes which have been incorporated in 20/25 Central Tax Notification, which are applicable from 1st of February 26. Now, this was all about the excise and uh, the pan masala and tobacco products. Let's talk about specified premises. What are specified premises? If you can recall, last year, January 25, a notification was issued wherein it was said that if the restaurant services or outdoor catering services are given from specified premises, they will be charged at 18% and they can take ITC. And if other restaurants and outdoor catering is provided at a premise which is not specified. See, earlier, before January 25, the specified premises were only those places which used to provide accommodation services where any unit of accommodation had a value exceeding 7,500 in any time during the year. Only those locations were considered as specified premises. Last year, January 25, they came up with a change and they said if you voluntarily want to disclose your premises as a specified premise, that means even though the unit of accommodation you provide, does not have a rate of more than 7,500, but still the restaurant or the outdoor catering services provided at your premises, you want to charge at full rate and want to take ITC, you can do so by making a declaration to your jurisdictional officer. Since beginning, we are saying that everything will be online, but last year this notification was issued, but there was no feature available online to make such a declaration. So the specified premises definition was changed last year to include first the accommodation where 7,500 is more, the value is more than 7,500, or any premise wherein hotel accommodation they file a declaration between 1st of January and before 31st March that they want to be treated as specified premises. So for next financial year, their restaurant services, see, I'm talking about restaurant services only. Their restaurant services and outdoor catering services provided on in those locations will also attract the 18% rate, and they will be eligible for entire ITC only and only if they make such a declaration. These declarations were required to be made offline manually to their respective jurisdictional officers before 31st March. So if you have done that, basically what the provision is, once the declaration is filed, it shall stand eligible till the time you opt out of the scheme, right? But now, since the last year it was only offline, and this year they have made it online. So all those people who have already filed their declarations last year manually, or all those people who wish to file their declarations for the financial year 26-27, they have to file it again online, and that feature has been made available for these people online. And once you have filed this online application, online you have filed this declaration, for subsequent financial years, there is no requirement of filing this declaration again, unless you opt out of that scheme. See, going in and coming out are very tedious task. Once you opt in this for the entire financial year, you will be able to claim the entire ITC, what all inputs or capital goods you'll use. But once you opt out, you again those supplies will be treated as for 5% without ITC, and they'll be kept at par to exempt supplies, wherein you'll have to apply rule 42 and 43 again. So switching in and switching out is a very cumbersome process, and one need to be very cautious in making all the calculations before actually taking the action. Right now, recently, GSTR 3B has been enhanced. What enhancements has been done? First, that interest liability computation. What changes have been made in section 50 and respective rules since 2017 is again a specific case study which needs 2 to 3 hours for entire deliberation, but I'll try to compute it in short. The section 50 of CGST Act says that there will be imposed an interest liability if there is a delay in making payment of tax. Now, what is making payment of tax? So they came up with the rule for calculation of interest. They said if, the section was also amended accordingly. The provision today stands as is, wherein supplies of a particular period are declared in that return, and tax which was supposed to pay in cash was deposited before the due date and was kept in cash ledger and has been used for making payment of tax by filing of return. So if there is any delay in filing 3B, the interest will not be applicable on the cash ledger balance which was available as on due date and which was utilized later for filing return. So basically, if I give you an example, I had a output liability of say rupees 1,000. I had ITC of say 600. So my net tax liability is 400, which I have to pay in cash. On the due date, I'm running short of rupees 100. I have to pay total 400, but I'm running short of 100. So what I do, I pay 300 rupees. I deposit the amount of 300 rupees in electronic cash ledger on or before due date. The very important word is due date. If I make payment after due date, then it is not going to be considered. So before due date or on due date, I make payment of 300. Now, in order to file the return, I have to make payment of additional 100 rupees, which I'm running short of. But I'll be having that amount maybe in next 4 to 5 days. So I'll be charged interest only on 100 rupees for the delay and not on 400 rupees. Like, but the important condition is that the balance should be there in the electronic cash ledger prior to or up to the due date of filing return. So uh, that feature has now been enabled in GSTR 3B. When you get next month 3B, the interest computation will be done as per this formula. Net tax liability, from that we will reduce the minimum cash balance in EFL. That is again prior to due date up to the date of debit into number of days divided by 365. So the interest will be calculated with this formula from the next month, which you will be filing 3B. Another interesting change, what they have introduced is from January 26, whenever you'll be filing this January 26, you must be filing nowadays. So the IGST, interestingly, IGST, if you have IGST output, right? I'm talking about IGST output. It is to be paid by using first IGST input, right? And then if you have credit balance available by CGST and then by SGST. But now they have introduced that from 26 onwards, your IGST outward supply liability can be paid once the IGST input has been set off completely by CGST or SGST in any sequence, like what we used to have for IGST input. IGST input, you have to exhaust your IGST input completely before actually going on to CGST or SGST input, right? So IGST input has to be first set off against IGST output, and then the remaining can be used against CGST output or SGST output in any sequence. They have brought this rule at par with the IGST output liability as well. Earlier, what the provision was, let's discuss the provision. There is section 49, subsection Y, which talks about the order of utilization. It has clearly mentioned that the amount of input tax credit available in the electronic credit ledger of the registered person on account of IGST shall first be utilized towards payment of IGST, and the amount remaining, if any, may be utilized towards CGST, SGST, or as the case may be, UTGST in that order, right? Then we have central tax shall first be utilized towards payment of central tax and the amount remaining towards IGST. Next, the state tax shall first be utilized toward payment of state tax and amount remaining towards IGST. Provided, this proviso is very important. What does it says? This says that provided that the input tax credit on account of state tax shall be utilized towards payment of integrated tax only where the balance of CGST is not available for payment. That means your IGST output is there. You have used IGST input. Now you completely use your CGST input, and only then you'll be able to use your SGST input. So the result of this provision was people were having accumulation of credit in SGST ledger, and it was increasing month by month after every return they file. Whereas they were supposed to pay tax in cash for the CGST component because that was used for making payment of outward IGST liability without being actually used for CGST. So there was an imbalance for making payment of CGST in cash, whereas SGST was available in credit ledger. Now, interestingly, the enhancements in 3B have been done, and now you can use SGST credit even before CGST credit for making payment of IGST output tax. Friends, for making this enhancement, I believe they were supposed to make amendments in law. Section 49(5) proviso to clause C still remains intact, that you cannot use SGST before CGST. Further, there is section 49(b), which talks about that which gives power to the government who can prescribe the order of utilization, and that section overrides section 49.5, no doubt about it. But according to that, there is only one rule, 88B, which talks about utilization of IGST in any order. There is no other rule which is talking about utilization of C or S for IGST payment. So the mechanism in law is absent, but the feature is 3B has been made available by way of a press release, and it has been mentioned in an advisory issued for filing GSTR 3B. But the government or the board has, just forgot, I think, to make amendments in the law and the rules. So with this, uh, I would like to suggest to please be aware of what is being done in the current returns. If you are able to utilize, it's very good. But if you are not able to utilize, we cannot blame on the advisory, because it was just an advisory, and we have to abide by the law. So the law is always superior. So let's move forward. Now let's come on to budget proposals. There are major four changes, not just major, only four changes in the budget. You guys must be having a question why the budgets do not have more changes and more proposals than what it used to have in pre-GST regime. The clear answer is now the parliament does not have independent power of making changes. Rather, whatever the GST council recommends, only those things are being applied or implemented by the parliament. So GST council, if they are recommending something by using already existing powers, they are being done by change in rules or by bringing notifications. Whatever the GST council recommends, and if that recommendation requires a change in law, like what I just discussed in section 49B, and a new rule is to be introduced, if the law is to be changed, that is, the act is to be changed, that is to be done through parliament, only through finance bill. So if there are changes which are recommended by the council and they require any amendment in the act, only those provisions are brought down by the way of budget. And there is a process of implementing these proposals. Once they are approved by the parliament, then they are moved by every state in their respective legislature. They are approved in their specific state legislatures. After that, a notification is issued that from this particular date, this amendment will be made applicable. So it takes around 6 to 8 to 10 months. Various notifications we have seen covering budget proposals from 1st of October. So it takes around this much time because it is to be applied pan India. And the central government alone does not have any power. They have to do it CGST plus SGST. Everything is to be simultaneously implemented in the entire nation. So that is why it takes time, and there are so less changes as proposed in the budget. Let's talk about the changes. These are important changes, no doubt. Regarding the post-sale discount, what is the existing provision? The existing provision is that if you are giving post-sale discount, there should be an agreement available at the time of supply. See? And such ITC has been reversed by the recipient from his in his returns. So these are the two basic conditions, that if you are giving any post-sale discounts, yani ki supply has been affected, and later on you are giving any discount, that so in order to reduce your taxable value by the discount amount, the conditions are that it should be agreed upon at the time of supply, and the recipient has reversed the ITC. And what was happening because of this? Various litigation was happening, because the department was saying, if I have issued a financial credit note to my recipient because we were not having terms at the time of supply, that discount was being treated as an income at the hands of recipient, and they were asked to pay tax. However, in September 25, a circular has been issued which has clarified this position about the discount. And again, that is a separate issue to be discussed. But discount has been to a various extent being settled now by way of that circular. And in line, Section 15(3)(b) is also proposed to be amended, wherein now a supplier can give post-sale discount simply like that, without having any pre-agreement or without any known condition at the time of supply. So if you want, like 15 days later, you want ki, I have made a supply, but since there was no agreement, but I want to give discount to my recipient, my buyer. So you can do so without any problem. The only condition still remains that you have to issue a credit note, right? As per section 34. And the ITC, the another important condition is that ITC has been reversed by the buyer. Again, how will you make sure that the ITC has been reduced by the buyer? For that, IMS is in place. You will give credit note to your buyer. That credit note will be accepted by him. Once he accepts, it will tantamount to the proof that he has accepted the credit note, and now he has to reverse his ITC, and accordingly your liability will also be reduced. In case if he rejects that credit note, your outward tax liability will not be reduced. So it's simple as that, right? Now, accordingly, section 34 also requires a change because 34 talks about credit notes. And till now, it was like whenever you have to issue one or more credit notes for one or more invoices where you feel like the taxable value was overrated or overstated, or the tax rate was highly charged and now it has to be reduced. So in that, a new line has been introduced wherein they say even if you have to issue a credit note for section 153B, that is for post sale discount, you can simply do so by issuing a credit note. Friends, these are changes proposed and these are welcome change, and this change particularly I will say that is going to bring ease of doing business. No matter how much GST is complicated, the government is really trying hard to make it simple. But again, GST, as they say, good and simple tax, it's not that simple. And making it simple again is not simple, it is a cumbersome process. But they are trying, let's see, let's hope for the best. Then another change proposed is there in the refund mechanism. There is a provision for provisional refund in case of export of goods in case of zero rated supplies. If a taxable person makes zero rated supplies and he applies for refund, there is a provision in section 54 which says that if the assessing officer deems fit, he can issue 90% of the refund amount provisionally, and after the actual assessment, the remaining 10% can be refunded. That provision was not applicable for filing refund in case of inverted duty structure. But this provision has been now proposed for inverted duty structure as well. Basically, the refund of ITC under section 54, subsection 3, clause 2, wherein they talk about a refund of ITC in case of inverted duty structure. There also, the provision of 90% of provisional refund has been proposed. And now, once the notification for implementing this section will be issued, you will definitely get. If you are applying for such refunds, you may get 90% within 7 days, and the remaining may be processed later. Further, there was a provision that if the refund application is filed for less than rupees 1,000, the refund will not be issued. 1,000 CGST and 1,000 SGST. They have made a exception in that case that this condition will not be applicable if the refund is on account of zero rated supplies of goods with payment of tax, basically which are exported through customs, and the refund automatically gets credited. So in case if that particular invoice amount tax is less than 1,000, that also will be processed now. Regarding the advance ruling dispute mechanism, we have in all the states are advance ruling authorities, and for same subject matter, various rulings have been issued diversely. So some say that it is in favor of SSE, while the others say it is against the SSE. Then we have appellate authority for advance ruling, but again the situation is same. One national appellate authority for advance ruling was proposed uh, to deal with these disputes, but unfortunately that was not brought in place till now by virtue of section 101B. But since GST is now coming into picture and they have started working and they are giving judgments, So the government says, ठीक है, if you are doing your job, let's shift advanced ruling disputes also to you. So what they have done is they have kept tribunals on equal position with that of National Appellate Authority for Advanced Ruling. And wherever they will refer in the law for National Appellate Authority for Advanced Ruling, it shall include a tribunal also. So the now cases may be heard by tribunals also regarding your advanced ruling authorities. Many taxpayers who have presence in more than one state and have applied for advance rulings in both the states, and both the states have given different rulings, so they are now struggling for what to do, and they are having a situation following one set of rules in one state and following another set of rules in another state. So what they want is that one set of rules should be applicable pan India. So now that will be done through tribunals. Another important change is in IGST Act. Before moving on to that change, let us first understand what is intermediary services. Intermediary services defined in section 2, subsection 13 of the IGST Act, which says intermediary means a broker, agent, or any other person by whatever name called who arranges or facilitates the supply of goods. See, these two words are important. We are not talking about section 24, subsection 7, clause 7, wherein compulsory registration is to be taken by a person who provides services on behalf of another. We are talking about actually a broker or an agent who is actually simply arranging or facilitating the supply. And for this, there should be minimum three parties involved. One, the supplier, one, the recipient, and the third person who's actually facilitating this supply by whatever means, maybe a commission agent. So if a person is providing intermediary services, of course, a person who's providing services on his own account is excluded from the definition. But majorly, any person giving services of a broker or an agent to facilitate supply of a third person is called an intermediary, and the services provided by him on this account are intermediary services. Another concern we need to study before going into the budget proposal is what is export of services. There are basically 5 conditions which classify a particular transaction as export of service. Namely, the supplier should be located in India first. Second, the recipient should be located outside India. Third, and the most important, place of supply of service should be outside India. Fourth, the payment is received in foreign inward remittance, and a certificate for this is to be issued by the receiving bank. And fifth, that supplier and receiver are not merely establishments of a distinct person. So if any of these 5 conditions is not satisfied, even though you are satisfying other 4 conditions, your transaction is not classified as exports, and you are not given any benefit which an exporter is due. Say, for example, if you are if you are exporting your services, you can make your supply without making payment of tax, and even you will get refund of the ITC. So for even if one condition not being satisfied, if you are asked that you are not an exporter now and you have to pay tax, you will not get refund of ITC, is going to create a lot of financial burden. And this particular provision is being challenged constitutionally also, whereas we have diversified judgments, and overall it has been said that yes, it is constitutional, and if the proper guidance is there and if the mechanism is there, it is constitutional. So what was wrong with the intermediary services, that is, in case of intermediary services, section 13 subsection 8 of IGST Act says that in case of intermediary services, place of supply shall be the place where the supplier is situated. So even if my recipient is outside India, me being supplier of intermediary services in India, otherwise the place of supply would have been outside India. But because of this provision, place of supply falls in India, and my transaction is not classified as exports. And unfortunately, I have to pay tax. Now, the budget gives a proposal that section 13 subsection 8 clause B shall be omitted. That is, for intermediary services also, the place of supply will now be determined by the residuary clause, that is section 13 subsection 2, wherein they have said that the place of supply shall be the place of recipient of service. So in that case, now if I am giving my brokering services to a person residing outside India, that service will be treated as exports and I'll be getting all the benefits which are due to an exporter. But friends, we have to be very careful. This is just a budget proposal. It has to be passed by both the houses of parliament. Then it has to be accented by the president. Then it has to be passed by all the states. After that, a notification will be issued for saying that this provision will be made applicable from this particular date. And only after that date, if you have a supply or an invoice raised on that date, only then it will be treated as exports. Otherwise, before that, the situation still prevails and it will not be treated as exports. I hope I have made myself crystal clear in this. This is the most important, the most awaited budget amendment and a welcome step because it is going to create huge opportunities for people who are giving brokering services to various people situated outside India. Now the market is open to you guys like the entire world. You can give your intermediary services to any person in any country outside India, and you can be treated as an exporter, and you'll be getting all the benefits out of it. So it is no doubt a welcome change and a very awaited one. Now, let's move on to recent judicial developments. My friends, GST 80 has been in application now, and recently on 10th of February, the first ever judgment which went through adjudication to first appellate authority and now to second appellate authority has been pronounced. What was the matter? The matter basically was related to difference in GSTR 1 and 3B. The case is of Sterling and Wilson Private Limited, and you can see the annotation. It is APL/1/PB/2026. APL is appeal, 1 is the number, PB is the principal bench, that is Delhi Principal Bench, and the year is 2026. It is pronounced on 10th of February 26, and the matter was related to 1 and 3B. Friends, this has opened, a way or rather an opportunity, I would like to say, for all as chartered accountants. We can appear before the tribunals. This is the highest authority wherein, as a chartered accountant, as a practicing chartered accountant, we can appear before. For obviously, for going further to high courts or Supreme Court, you need a law degree. So this is one such area where we can explore, and in GST there is a lot of professional opportunities and we can explore these. And the opportunities we can see is by studying this very judgment. Once I'm done through with this judgment, you'll be able to identify that yes, even you can also participate in these activities and you can present your case before the tribunal. It's not that difficult. Once you go through the process, you come across certain teething problems, but in the long run, it is definitely a good profession. So let's discuss the case. The matter was related to difference between GSTR and 1 and 3B. What happened? Like GSTR 1 was filed, and this matter is related to financial year 18-19. GSTR 1 was filed, 3B was filed. At that time, 3B was used to be filed before 1. So at filing 3B, the tax was paid. When 1 was filed, certain credit notes were issued, and there may have been some mismatch or some reconciliation, and the tax ultimately paid in 3B was lesser than what was reflected in 1. There could have been various reasons. There could have been various reconciliations. The first and foremost aspect is whether this case is pertaining to Section 74, that is, whether it is a fraud case. This case was decided that it is not a fraud case by the appellate authority itself. First appellate authority, what they did, they said this is not a case covering of fraud, so it is not not to be issued in Section 74. What they did is appellate authority in their order changed the order from Section 74 to Section 73 and quantified the amount of penalty at the rate of 10%. Whether they can do so, this is the another question. As per section 75 subsection 2, if the appellate authority or the appellate tribunal finds that the case is not pertaining to section 74, rather it is pertaining to section 73, that is, it is a non-fraud case, maybe a clerical error or something like that, the matter has to be decided again by the original proper officer, which has been clarified recently by way of a notification, who will be the proper officer in case of section 75(2). So the proper officer is the original adjudicating authority who had initially issued an order, not the appellate authority, not the appellate tribunal. So the matter has to be remanded back to the original adjudicating authority for fresh adjudication of the matter under section 73, and a fresh order is to be issued. This cannot be done at the appellate stage and cannot be done at the appellate tribunal stage, and only the original adjudicating authority can pass a fresh order. So it has to be remanded back. Now, two things. One is 75(2) has been made clear who can issue a fresh order. Then, how do you deal with these situations when there are clerical issues, when there are time lapses, but the taxpayer was honest and they never had an intention to evade payment of tax? All these are setting principles for your future litigation. See, what are the key takeaways from the judgment is section 72 is proper officer, this we have discussed. Then, if an honest taxpayer is there, and if we are able to prove that whatever was done was not with the malevolent intention, ultimately there is no loss to the revenue, it's just a clerical issue or maybe a compliance error, these matters are considered for the reason GST is a new law. Anybody, it may be a human error, anybody can commit mistakes, and if the mistakes have been committed inadvertently out of maybe non understanding of the law or the procedures, it does not tantamount to imposing harsh penalties on the taxpayer. So what judgment was given, that the matter was remanded back to original adjudicating authority, and the appellant is required to file amendment petition and reconcile the differences. Boss, you clear your differences, reconcile the transactions, and if the adjudicating authority comes across that yes, the tax is paid and there is no tax paid or not, there is no tax not paid or short paid, you have to do it accordingly. And the adjudicating authority is also required to examine the genuineness of the credit notes or debit notes and accordingly issue a fresh order. So this is giving a ray of hope to all those judgments or all those cases wherein matters are pending, maybe because of differences of 2A and 3B, maybe because of certain time lapses, maybe because of differences 1 and 3B, because of cancelled supplier GST registrations by backdate, for n number of cases wherein the taxpayer himself has done nothing wrong, but he's being penalized for the actions of the supplier, and maybe for certain technical glitches of the portal, or maybe for some understanding issues with the law. All these things can be taken care by the honorable tribunal. And my dear friends, I'm looking for a bright light in future for these type of judgments more to come. We'll discuss two more decisions which have been issued by various high courts, and then I will give rest to my session. There is Bambino Agro Industries Limited by Allahabad High Court, wherein the issue was related to ex parte orders which were issued in huge numbers and simply uploaded on portal without calling the taxpayer and without giving the hard copy of the orders and show cause notices to the taxpayers. Simply they were conducted online and online issued by way of uploading the orders on the portal. Friends, this is again a hot topic wherein section 107 is being talked about. What is the communication? The time of 3 months to file an appeal is from communication of the order and not from issuance of the order. This particular judgment also emphasizes on what is communication. The court has rightly held that simply by uploading orders on the portal without effective and provable communication to the taxpayer, cannot be treated as valid communication. So, in case if you have come across such a situation that order was uploaded online and was never communicated to you or the taxpayer via mail or through a hard copy of the document, you can always argue that, boss, the order was communicated to me only when I downloaded it from the portal. And I did that because my bank account was attached or recovery proceedings were initiated. And only then I came to know about the proceedings. So the order was communicated on that date, and from that 3 months should be counted, and my appeal limitation is not hit. So this is one more landmark judgment which you can use. It is Allahabad High Court judgment, Bambino Agro Industries. One last judgment which I want to discuss is Right Water Solutions Limited by Honorable Bombay High Court, wherein a single show cause notice was issued for multiple financial years. And the Honorable Court has held that the adjudicating authority has to issue separate show cause notices for each financial year. They cannot issue a single show cause notice for multiple years because the law is framed in such a way that the assessments are to be done yearly for each particular year. The review of this judgment is the people have mixed feelings because one single show cause notice will attract one general penalty for all 5 years maybe, but every show cause notice for every single year will have again a general penalty for each year. So we have different feelings out of it. Although if you are having single show cause notice for multiple years, you can always use this judgment and turn the case in your favor by saying that it is not called for and it is to be quashed. But again, read the last line. The liberty has been given to the department to issue fresh notices year-wise in accordance with the law. So accordance with the law means the timeline will apply, section 73 and 74. Fresh timelines will apply. It is not that the case is remanded back. It is that the department has at liberty to issue fresh notices. The original notice which was issued for multiple years has stands quashed. So this is from my side, and over to you, Akshatji. If you have any queries from the audience, I can address to them, or else this is the end of my session. Over to Raja Motwaji.
Yes, sir. Sir, one question from a member is, even though GSTN has mentioned that GST portal will allow to pay IGST liability of GSTR 3B using available CGST and SGST, ITC in any sequence, but actually it is not happening in the portal.
This is exactly what I said. The law is still not amended. The rule is not in place. I cannot confidently say that the portal will allow. I practically myself have not tried it, but there is an advisory issued by CBIC that it is done and it will be available on the portal. But since there is no provision in the law, how can they do it? It's obviously because no action of government or the board can go over the what the law is. I mean, Anup sir will agree with me on this point.
Certainly, certainly. Yes, Devenji, you are right.
Any other
Another
question?
question is, in case of builder purchase of TDR, GST applicable under RCM for residential builder at the rate 5% or 18%. And GST
For
ITC
TDR,
is, yes, sir.
sorry, please continue.
And GST ITC is available or not against the receipt of the flat sold in 5%
Can you
rate.
please repeat the question?
In case of builder purchase of TDR, GST applicable under RCM for residential builder at that 5% or 18%.
Correct.
And GST ITC is available or not against the receipt of the flat sold.
Yes, sir. The flats, basically the construction sector is again a very lengthy discussion to be done. But in short, I will try to answer it. The first and foremost, RCM on TDR is again under challenge, whether it is actually applicable or not. Whether there is an underlying supply of service or not, that is a separate question. But to answer your question, if it is applicable, if you are saying that yes, RCM is applicable, it will be taxed at 18%. And yes, the builder is entitled to only one single ITC, that is the paid on TDR. Only that ITC is available. Again, that has to be made available proportionately. If at the time of completion certificate you have some flats which are unsold, you have to reverse this ITC also with that proportion. This is the answer in short. Otherwise, this entire topic again needs at least 1.5 hours.
Okay, sir. No more questions, sir. Thank you for the
Thank you so
excellent
much, sir. Thank you
session.
so much for having me and deliberating my views. And it is an honor to share the platform with Anup, sir. I have been an audience to him as well. We have attended so many lectures of yours, sir. It is an honor for me, and I would like to thank the CP committee for giving me an opportunity to doing this webinar. Thank you so much.
Devanji, I
Thank you
must
for
say,
Thank
you
you
have
so
been
much, sir.
fabulous. You've been fabulous.
Thank you, sir. Thank you so much.
देवेंद्र भाई नमस्कार। अनूप सर
सर नमस्कार, कैसे हैं?
Namaskar,
CP
नमस्कार
Satish
Chairman
ji.
नमस्कार राजा
Satish sir
नमस्कार।
joined the meeting. Welcome, sir.
तो मैं इसीलिए तो सोच रहा था देवेंद्र से भाग नहीं जाए, मैं बात कर ही लेता हूँ जाते जाते। और सर अनूप सर कैसे हैं?
बस बढ़िया हूँ सर। देवेंद्र जी ने बहुत ही बढ़िया सेशन लिया एंड ही इज रियली
मास्टरपीस,
एजुकेटेड।
इज मास्टरपीस पर्सन। आप भी मास्टरपीस हो, वो भी मास्टरपीस
आपका
है।
आशीर्वाद है सर।
राइट राजा, यस कंटिन्यू राजा।
Now, for today's second topic is recent amendments in income tax. For this session, we have Anup Bhatia sir from Jaipur, Rajasthan. He is an insolvency professional and practicing chartered accountant serving as a founder partner at the firm. He specializes in tax and financial planning along with consultancy in insolvency resolutions, investment planning and auditing. He has over a practice since 2011 and previously served as state head accounts and deposit at HDFC Limited, Jaipur for 7 years. He has been faculty for direct tax at the CA final level of ICI for more than 18 years, contributing to professional education. Now, I would like to invite our speaker for deliberating of his session.
Thank you, Murdod ji. My heartfelt thank you to C Institute, especially my elder brother Satish ji Bhai Sahab for giving me this opportunity. And my dear friends, income tax has ample amendments to see in this budget, yet the indirect taxes might not have because of that GST Council concept. So, in today's session, I'll put up before you certain important amendments which are proposed by this Finance Bill 2026. And these amendments are going to impact wherever in our practicing field. I'll try to touch upon those points that how, while we are dealing with our clients, while we are dealing with the practical aspects of a particular case, what are the various nitty-gritties which we can develop around these amendments. So that is probably the mindset which Satish ji has asked me to take care of. And I'll take you through a presentation, PPT, so that we may. Is it visible? Okay. Okay. So let me take you through these important points or important amendments through this presentation. So what I'm doing, my dear friends, I will start from first and foremost, which is foreign asset disclosure scheme, a window for 6 month period. In the recent past, we all might have experienced that our client or any reference person might have been receipt of some income tax communication wherein income tax department is asking such person that look, you did not disclose your foreign asset. Now, because of DTA impacts, number of assessees all over India have been in receipt of such kind of communication and looking into the genuineness of such case, but the harsh penalty prosecution provision, it was necessitated that people may be given an opportunity wherein they may come forward and disclose their foreign asset which they did not disclose, which they could not disclose in their ITR under the FS schedule, foreign asset schedule, FS schedule. So this scheme titled Foreign Asset of Small Taxpayer Disclosure Scheme 2026, which will cover basically three kind of scenarios. One, undisclosed foreign income. Second, undisclosed assets located outside India. And third, specified foreign assets acquired from foreign income when assessee was a non-resident or from income already offered to tax in India which have not been reported in the relevant schedule of the return of income. Now, this third category tells us the importance of this kind of compliance, where law is even asking to those to comply with, to come clean in a scenario where such person was, say, for an example, a non-resident. He made such asset when he was earning foreign income. He made such asset with the help of the foreign income only. But what is the mistake on his front? That while this person becomes resident, he missed to report such asset in his Indian ITR. So this is after he becoming a resident. So there are two kind of persons you can understand. One, those who are resident but has undisclosed foreign income or has undisclosed asset located outside India, or those who are required to consider the foreign income reporting or foreign asset reporting in India, but they did not. And the second category is those kind of person or those kind of taxpayers who have now become resident, but while they were a non-resident, they had some foreign income through which they have created some foreign asset, which they have not reported while they become resident. And this scheme, my dear friends, therefore provides two kind of option. One, the taxpayers who have undisclosed asset outside India or undisclosed foreign income, after paying 30% of tax plus 100% of set tax. So say for an example, somebody has booked a flat in Dubai and he made an investment of rupees 50 lakh for such flat, which he did not report in his Indian ITR FA schedule. Now, what is this scenario? If this asset is not an undisclosed asset, this scheme should not be availed of, this scheme should not be applicable. This scheme would apply when the asset is undisclosed. Now, how an asset will become undisclosed? In my opinion, an asset is undisclosed when the payments which are made are undisclosed nature of payment. Say, for example, somebody has booked a flat in Dubai while sitting in India. So he was paying the consideration for such flat in bits and pieces in cash. Now, this person is interested that let me disclose this asset here in this scheme. So what he'll be doing? He'll be paying 30% of tax on the value of such asset and he'll be paying 100% of such tax, that is equivalent amount of the value of such asset for the purposes of this scheme. But there is a capping that the undisclosed foreign income or undisclosed asset outside India, both aggregated together in such case does not exceed 1 crore. So if the investment is exceeding 1 crore, then this scheme would not apply to that person. And then income tax department has alternate ways and means to cover that person, maybe under the Black Money Act or any other provision of income tax law. And where there is a person who was a non-resident, as I said in my first slide, that where there is a person who was a non-resident and he did not disclose such asset which he earned outside India while he become resident in India, in such case, the person would be required to pay only a fee of rupees 1 lakh. Now, there the remedy is quite easier. That is 1 lakh rupees fees payment would be required and the value of the asset located outside India in such case would not be exceeding rupees 5 crore. So this window of the foreign asset disclosure scheme for small taxpayers would be enabling two kind of persons. That is what we are supposed to take as a color from here. And as a professional, we may find that in the near time to come, when this scheme will be operative, the date of it would be notified in the time to come, which has not been notified yet. So we need to wait for that date. We need to wait for the relevant notification. And once it becomes operative, then we can go into this scheme by way of filling an electric facility form would be there, through which we have to opt out for this window, opt in for this window. Now, I take you through the next amendment, which is kind of enabling an option of filing an ITRU even after issuance of Section 148 notice. See, as you all know that Section 139, subsection 8A of the present Income Tax Act 1961 provides that ITRU option would be available to the assessee subject to payment of additional tax. However, there are certain restrictions. And one of those restrictions is that once your assessment has got opened, then you cannot file ITRU. So a remedy in such kind of scenarios being provided at a heavy cost. In my opinion, it is a heavy cost, but you as a professional would be evaluating, looking into the facts and scenario of the case, whether in such scenario filing of an ITRU even after issuance of 148 notice would be a feasible option, would be a justified option for the assessee or not. So at present, filing of ITRU for disclosing additional income in respect of tax year is not allowed if updated return is a return of loss or in case where the assessment or reassessment is pending or has been completed in respect of relevant tax year. Now, the ITRU option is being allowed in two scenarios. One, that will be available from the next year, which will be when your loss is getting reduced and when your reassessment notice has already been issued. These are either or conditions. Say, for an example, somebody previously reported 1 crore 50 lakh loss in his or her return or its return, and now they wish to reduce 1 crore 50 lakh loss to, say, for example, 60 lakh only. Now the ITRU option would be available. Secondly, suppose a person is in receipt of 148 notice. The matter involved is of rupees 30 lakh rupees. The person, with the help of the professional like you, gets to know that this 30 lakh rupees is going to be taxable undoubtedly, which he could not offer in his return. Now he has an option that what this person is supposed to do, this person is supposed to pay the tax on such 30 lakh rupees as if what he was supposed to pay if on the date of filing of such ITRU, he was supposed to pay including tax and additional tax. And on such tax and additional tax, 10% extra would be required to be paid by such person. So I read this last para. In cases where ITRU is filed in response to reassessment notice, taxpayer will be required to pay a further additional tax of 10% in addition to additional tax payable on the aggregate of tax and interest payable on filing of such return. So you can see that this is another measure through which the revenue, or I can say government, is trying that, okay, let's collect the tax upfront and let's leave that person thereafter. And then you need not to go, you means department need not to go into the depth of the assessment, need not to go into the penalty, need not to go into the consequential appellate proceeding. So the matter would get closed at the beginning itself. So as I said in beginning, that here it is you as a professional who has to decide that whether such kind of requirement exists. Suppose if you have doubt regarding the sustainability of issue, that the issue would not sustain ultimately against you, then you should go into the assessment. But if you feel that the case is weak in your particular aspect, then you may think of filing of this kind of ITRU scenario. Now I go to the next point. I hope I'm not very fast. Immunity from penalty in the case of misreporting of income. Hitherto, this penalty, which was inserted in the law by the Finance Act 2017, if I am correct, and it was applicable with reference to, or maybe Finance Act 2016, assessment year 17-18 onwards, my dear friend. You all know that underreporting, misreporting have come as an option to 271(1)(c), which was the previous regime of concealment of income. And now concealment of income is not the correct term. The correct term is first, wherever any addition taking place over and above 143(1), it will be treated to be underreporting. In underreporting scenarios, as per my professional experience, earlier also there were 270AA immunity provision, but hardly people were approaching to the department for 270AA. But actually, in most of the assessment, wherever an addition takes place, higher are the chances of getting attracted the provisions of misreporting of income. And here, when this amendment is proposed with effect from 1st of March 2026, the government in section 270AA through the finance bill has proposed the amendment in the existing 270AA subsection 1. And now the rewritten subsection 1 reads like this. An assessee may make an application to the AO for to grant immunity from imposition, or as the case may be, waiver of penalty under section 270A, and immunity from initiation of proceeding under 276C or double C if he fulfills following condition. Mind you, my dear friend, 270AA not only provides immunity from penalty, it also provides immunity from prosecution. Now, what are the conditions? Namely, the tax and interest payable as per the order of assessment under 143(3), reassessment under 147 has been paid within the period specified in the notice of demand. 2. where the penalty has been levied or as the case may be leviable. Now, here there is a difference. In the previous 270 AA subsection 1, the requirement was that the penalty might have been initiated, but it is not imposed. But now law has changed its scenario and it is saying where the penalty has been levied, as the case may be leviable under the circumstances referred to in subsection 9 of 278. Please note, very clearly mentioned leviable under the circumstances referred to in subsection 9 of 278, which is applicable for misreport. Additional income tax amounting to 100% of the amount of tax payable on underreported income has been paid within the period specified in the notice of demand in lieu of such penalty. Now here, the law is saying that okay, either the scenario is that the penalty has been levied, and what you will be doing, you will be opting for immunity under 270 AA, and you are supposed to pay 100% of the amount tax payable. So it means what? That rather than 200% of penalty, which is leviable in misreporting cases, here it will be only a case of payment of 100%. But clause B, my dear friend, applies only in case of misreporting. If it is a case of underreporting, then the condition is that, then in my opinion, clause A and C would apply. But if it is a case of misreporting, A, B, C, all three would apply. Now, in this connection, I would also like to read subsection 2 and 3 of 270 AA. Like subsection 2 says, an application referred to in subsection 1 shall be made within 1 month from the end of the month in which the order referred to in clause A. Now, order referred to in clause A is assessment order. And B, and clause B of said subsection has been received by the assessee in such form and verified in such manner as may be prescribed. Now, government should have tried to make it clear. Clause A is a different scenario where we may be approaching even for underreporting related immunity. And clause B is a scenario where we are reaching for misreporting related immunity. So both time limits may vary in my opinion here, but whatever law is I am just putting up before you. You shall, on fulfillment of condition specified in subsection 1 and after expiry of the period of filing of appeal specified in clause B of subsection 2 of 249, grant immunity from imposition as the case may be, waiver of penalty under section 278 and initiation of proceeding under 276C or whatever C. So, in my opinion, in the time to come, the government should come up with certain FAQs regarding subsection 1, 2, 3's applicability. And that would be the proper guidance in support of 270 AA. As a professional, you and me need to see that which would be a fit case where even in the case of misreporting, the person should opt for this kind of case. The person should opt for a kind of immunity under 270 AA. And when it is a matter in your opinion, which is a strong case in the case of assessee for fighting the penalty levy even in the appellate proceeding, then probably we will not opt for 270 AA scenario. So this is what is regarding 270 AA. Now this year, if you see that the budget, government, rather the finance minister has been provoking that this part, we are non-criminalizing certain offences, we are trying to rationalize the prosecution proceeding. So these amendments which will be proposed effective 1st of March 2026, they are saying that, okay, if there is a failure to produce books of account document, or there is a failure to pay and ensure payment of tax, where the payment is made wholly or partly in kind, in case of benefit or perquisite provided in the course of business profession. Like, in section 28, if there are benefit or perquisite coming out of the facility provided to you, which is directly not in monetary format, but tax liability get attractive. In such scenario, there is a non-criminalization which the government is proposing, like in the case of winning from lottery crossword puzzle, or there is a case of wholly in kind payment in case of payment made for online game and for transfer of virtual digital asset. The government is saying that, okay, these kind of offenses, we are non-criminalizing. I will touch upon this point further. Further, shift from penalty to fees regime. This is really interesting. I don't know how many of you appreciate this kind of approach of the government where they convert the penalty into a fees regime. And I think that these kind of changes in the law are basically meant to provide the benefit to the revenue only. Whatever it is, the penalty for certain technical defaults, for example, failure to get accounts audited, furnishing a statement of financial transaction or reportable account, non-furnishing of transfer pricing audit report will now be removed and instead a fee regime is being inserted. And rather, you would be, I may say, surprised to understand that suppose hitherto the tax audit report was not uh, obtained, then what was the penalty? 0.5% of your total sale gross receipt turnover or 1,50,000, whichever is low. Now they are saying if tax audit report is not filed, then up to 1 month delay, you will be liable to pay 75,000 rupees of fee and tax audit report will be accepted. And after that, 1,50,000 rupees fees would be applicable. In my opinion, it is quite heavier. Similarly, in TP report cases, the fees shall be up to 1 month 50,000 and after that it will be 1 lakh. So you can understand that this fees regime is also going to, because hitherto you all know that even if the tax audit report was delayed, not in all 100% cases the penalty was attracted. Or even if penalty got attracted, you can give genuineness of your case because the concept of mens rea was there in the law. And if you can establish your genuineness, then the penalties were not levied. There were many judgments. So the effort to reduce litigation in such a way where the assessee is being forced to pay the fees, in my opinion, is not a welcome step. But whatever there it is in the law, I'm putting up before you because one interesting thing you can note that you can file appeal against the penalty, but you can't file appeal against the fee. So government in a way is trying that okay, now we will not give you an option to file even appeal against the kind of fees. So I object to these kind of amendments, but with due respect, they are there. Relaxations in prosecution provision. So as I said, that there are certain relaxation earlier. Prosecution for defaults such as failure to deposit TDS, TCS, willful tax evasion, failure to file return has been reduced. What they are saying, maximum imprisonment, which will be reduced from 7 years to 6 months or 2 years, depending upon the amount of default, and rigorous imprisonment being replaced with a simple imprisonment. Further, no imprisonment where the amount of default does not exceed 10 lakh. So this is the kind of relaxation in the prosecution provision. Yes, in my opinion, attracting a person under the prosecution provision may be easy for the department, but not easy to get it implemented because these prosecution cases go long. And probably to avoid that kind of scenario, the government is saying that, okay, we are relaxing in certain cases. The prosecution provision under the Black Money Act, now here I am just touching upon one point from Black Money Act, where also prosecution related relaxation is there, which is said Black Money Act 2015 would not apply to non-disclosure of asset other than immovable property where aggregate value of such undisclosed asset does not exceed 20 lakh. Therefore, this aligns with the corresponding penalty relaxation provided in the Black Money. The next provision, which is regarding the stay of demand in the pending appeal cases. Now, you all know that wherever you are fighting a matter before CIT appeal, then the thumb rule says that 20% of the demand needs to be paid upfront. Now, this demand would include tax, interest, any fees may also be attracted in this kind of coverage. And even in the penalty related appeals, this 20% thumb rule applies. Now, what government is saying through the proposed amendment, it is saying that the taxpayer can obtain a stay of demand on an order which is an appeal by way of paying 20% of amount payable under the Act. The stay can now be availed of by paying only 10% of the amount of tax. So 10% is not only 10% of tax plus interest, it is only 10% of tax. So I think that these kind of amendments are welcome amendments and they provide relief to the assessee. So I appreciate this amendment. Yet I may not be the authority that who can appreciate, who can condemn. I know. But since my fraternity members are there, so what I'm trying that whatever views we as fraternity members could develop, I'm trying to put up that view there. Now, changes in ITR filing due date, my dear friends. Now, what is the amendment? As you all know, that presently those assessees who are not liable for audit under any law or under the income tax law are required to file their return by 31st of July in the next financial year. And in case a person is having income from business or profession but not liable for audit or other audit, similarly, a case of a partner of a partnership firm which is not liable to the audit, a new ITR filing date will be applicable, which shall be 31st of August. So what will happen? That now you have two bifurcation of non-audit cases. One, in usual cases, 31st of July. But those having income from business or those being partner of a partnership firm in which tax audit is not applicable. Because if audit is applicable, then the date would be 31st of October. In such case, it will be 31st of August of the next financial year by which you are supposed to file the ITR. Now, the next amendment you also might have heard is regarding the revised ITR filing time limit to be extended by 3 months. But again, government wish to charge certain fees for the same. As they have previously reduced the time limit of filing revised return up to 9 months from the end of 11th assessment year, and now they are extending it up to 12 months from the end of 11th financial year. So they are saying, if I spoke wrong, I would correct. 9 months from the end of 11th financial year was the existing time limit, and they propose to enhance it now to 12 months. But post 9 months and up to 12 months, they are saying we will charge you a fees. If your total income is up to rupees 5 lakh because you are making a revised return, then they will charge you 1000 rupees, and in all other cases, they will charge you 5000 rupees. So this is again a fees regime coming. You can't file an appeal against this. You have to think about it that, okay, if you wish, what is the benefit in this kind of scenario, my dear friend? Hitherto, after 9 months, we were supposed to file ITRU. If something comes as an omission or wrong statement and you want to change, and that too is possible only when you are doing a positive change in favor of revenue, not in favor of assessee was law. But now you get 3 months relaxation. Now, recently I came across this question, why not this kind of option would be available for the assessment year 25-26? And I said in one of my short that at least in the month of March, this kind of option should be allowed to the assessee. But it will be interesting to see whether this amendment duly applies for the financial year 24-25, that is assessment year 25-26 or not. Critically, in my opinion, it should be available. Okay. Now, one interesting thing they are doing in the new act, and you will see more than 80 amendments are being proposed in the new Income Tax Act 2025, and which has yet to take its application with effect from 1st of April 2026. But even before the law becomes operative, the amendments are proposed. And one another interesting amendment in this regard coming in the time is assessment and penalty proceeding to be finalized through a common order to reduce litigation. So this you will see in the time to come. Presently, we take the help of this notion. Penalty proceeding and assessment proceeding are independent to each other. This is a concept. When I learned income tax nitty-gritties from my elder brothers like Satish ji, then we learned it like this, that the assessment proceeding and penalty proceedings are independent to each other. But even if this learning and even this learning rather has provided benefit to us in most of the cases, as you remember that in various assessment order, if penalty initiation is not mentioned, we might have fought that case in a way that the AO did not have intention because he did not mention in his assessment order regarding the initiation of penalty, then how the penalty could be levied on me. But now they are saying, okay, assessment and penalty proceeding will be finalizing through a common order. This appears to be straight, but again, this is from the point of view of revenue and amendment, not from the point of view of assessee. Yet you can say that, okay, if the assessee is there, then he would be probably be able to see a clear picture through one order. But suppose if the penalty is also being simultaneously, rather not simultaneously, penalty is also being finalized through a common order, my dear friend, the demand size would be higher. Now, you can argue that only 10% of tax is required to be payable, Mr. Bhatia. But when the demand side is higher, then the chances are that the assessee would also come to surprise when he notes that, say, for an example, on a 10 lakh addition, 3 lakh tax and interest is demanded. As on date, the penalty is decided later, which you generally ask them to keep on hold. Now they will give you a penalty order within assessment order. So what will happen? The assessee will receive 3 lakh plus 6 lakh, 9 lakh rupees. So naturally, to his surprise, it would be quite surprising to him that, okay, what has happened to his case? So that is the kind of terror which will come out of these kind of orders, in my opinion. Now, one interesting amendment which you may further dwell upon to see, okay, what is going to happen on this front. In the new law, they are saying, in the new law means Income Tax Act 2025, the law is being amended that additions which are presently in the nature of section 68 to 690 do attract a 60% tax rate and a penalty of 60%, 10% of the tax amount. Whereas they are saying that, okay, now we will reduce it from 60% to 30%. If you remember, 115 BBE is the section which provides 60% rate. And they are saying we will reduce the tax rate from 60 to 30 and a penalty of 10%, which we earlier proposed, is being omitted. However, such an offence will continue to be subject to a penalty of 200% applicable for misreporting of income. So now the ball will move from the court of 10% penalty to 200% penalty. But as you today understood with me that there is a 270 AA immunity, so probably if 30% tax is paid on the addition and 100% of misreporting of income related immunity you are opting for, then probably you may get settled in a 30 plus 30, 60% scenario. So maybe if this kind of strategy is adopted, then the assessee would be in benefit. But if somebody files an appeal and that appeal doesn't sustain in his favor, then ultimately such person would be paying 30% plus further 60%. So the case will go to even 90%. Here, when I talked about immunity related thing, the government is saying that, okay, taxpayer can however claim immunity from such penalty. So when I quoted 100%, government said, no, Anubhatia, please note, here the immunity from penalty would be available, but it will be available at 120% of tax payable on such income. So it is not 100%, it will be 120% of tax payable. I don't know how the government derives the formula to come to 120% or 110% or there should be some rationale, probably in their mind. That is why they are coming up to this level. These amendment will apply from the tax year 26, 27 onward. Now let's come to taxation of buyback of share related amendments which are proposed in this budget. As you all know, in the last budget, that is prior to budget 2026, in 2025 budget, the government said, okay, we will tax whatever value you are receiving, the value of which you are receiving as a credit on account of buyback of share as income from other source. Now this initiated a debate. Debate of what kind or a dispute? What will happen to my original cause for which I bought those shares? There was no answer. That was to be treated as the capital loss in the hands of assessee. If you have any capital gain in that year, you set it off. If no, then there you are at liberty to carry it forward for 8 years, provided you are filing your return in time. Now government has corrected its mistake. That was an absurd provision. Government is saying through this budget that buyback of share now will attract capital gain tax in the hands of shareholder, and which is the logical part. However, additional income tax on such capital gain shall be payable by promoter shareholder, which shall result in an effective rate of 22% for domestic corporate shareholder and 30% for others. So that is okay. If you are a normal buyback person, then you will attract capital gain, say short term at the rate of 20%, long term at the rate of 12.5%. But if you are a promoter or you are a other person, but promoter, then in that case 22% effective tax rate would apply. This is what government is saying. In case of corporate promoter, the rate will be 22, and in case of other person, it will be 30%. So there, this concession rate of 12.5% or 20%, which I discussed, would not be applicable. Now let's come to this part. Taxation of disability pension in case of armed forces employees. So what was happening that in case of armed forces employees, my dear friend, if there is a disability pension component and that is being received by a armed force retired person, then their entire pension was assumed or treated to be exempt. And there were quite litigation on that part also. And if you see here, what I'm quoting before you is the Schedule 3 of the new Income Tax Act. And you can note my point. Schedule 3 of the new Income Tax Act 2025 is nothing but Section 10 of the existing Income Tax Act 1961. And it is interesting that existing is Income Tax Act 1961 as well as existing is Income Tax Act 2025 even. But 2025 would apply effective 1st of April 2026. What I am putting up through this, that this Schedule 3, which is nothing but Section 10, has a table, and in that table, after serial number 38, a serial number 38A is being inserted. I don't know why they are coming up with 38A. They could have done, last was 39, they could have inserted 40, they could have inserted 41, but they are inserting 38A. So what they are saying, disability pension received including service element and disability element both will go exempt, for whom an individual who has been a member of the armed forces including paramilitary forces and the individual has been invalidated out of the service in the armed forces on account of bodily disability attributable to or aggravated by such service, and the individual has not retired on superannuation or otherwise. So presently what is happening, I have seen such cases where people on account of superannuation related retirement also have been in receipt of disability pension. They will not be able to get this benefit now. What has been specifically put in, that if you have been invalidated out of the service in armed forces on account of bodily disability attributable to or aggravated by such service, then only this pension, disability pension and including other pension, that is service element pension, would be exempt. So probably armed forces persons who have retired or who have taken superannuation and they have disability. And my experience is most of these armed forces persons, if you will connect to, you will find that they have a component of disability in their retirement PPO. So till now, what was happening, that most of them who were availing disability pension component were offering it exempt, but now a clear distinguishment is being done. Similarly, my dear friend, in this third schedule, there is one more serial number 38B being inserted. So when you are saying 38A, 38B, you can understand that this law is also going to be the same as how the present Income Tax Act is. Like there is a section 10, 10A, 10AA, 10AB, like so. Whatever they are doing, I'm just putting up before you. And this too, when the law is yet to get implemented effective 1st of April 2026. These are some interesting things. So, but a favorable amendment, they are saying that, okay, motor accident claim will be fully exempted. Hitherto, it was 50% which was deductible and balance 50% was taxable. Now, one more amendment, I don't know why they have done so, or what is the ego that a person could have got hurted, which got satisfied because of this kind of amendment. I sometimes don't understand the logic of the amendment, but they are saying, okay, no deduction of interest paid against the dividend income. And in the new law, in section 93, they are proposing an amendment. Whereas as per the existing provision of income tax law in section 56, read with 57, you can claim interest expenditure up to 20% of dividend income while you are offering your income under other source. But effective tax year 26-27, that is new law, now this 20% capping of interest even allowable to the assessee would not be allowed. So nil deduction of the interest. Now a question comes. Can we then claim such kind of expenditure forming part of cost of acquisition or not? Actually, I tell you, in my opinion, if suppose I have availed certain credit facility, nowadays most of the people I see have the credit facility through their broker, or might have obtained a loan against security, might have obtained an OD, might have obtained a term loan and which he or she is using for investment in the market. One thing is very clear. Against dividend income, now you will not be eligible to claim it effective FY 26-27. But such interest which you are using for your share market trading, which you might be reporting under capital gain, or which you might be reporting under PGBP. Can it be claimed there? PGBP, undoubtedly you can claim. Capital gain, in my opinion, it can be claimed. But the question comes, how would you attribute that interest to the cost of a particular share? Now here, since all my audience is a chartered accountant, I think that they can develop a formula on their own unless law provides them a formula through which suppose the value of the transaction or the credit period of the transaction can be evaluated and then the interest can be proportionately claimed forming part of cost. So I think that when government is giving a clarity that we will not allow you to claim such interest against the dividend income, then earlier it could be that okay, 80% is disallowed, 20% is allowed. So if that 80% is disallowed, it is elsewhere also not available. That interpretation could be developed by the regulator. But this kind of amendment, if taken on a positive side by a chartered accountant like you, I am of the mind we can now claim 100% of the interest incurred against the capital gain income. In by treating the same forming part of either the cost of acquisition or cost of economy. So this is my view on this amendment, my dear friend. You may have a different view. Now, changes in the MAT provision. There are significant changes in the MAT provision. Yet my understanding says most of your companies, which are your client, would have already come in the new regime of 22%, 15%. So they are already out of MAT. But whosoever is still covered under the MAT, for them they are saying MAT proposed to be reduced from existing 15 to 14%. MAT proposed to be inapplicable to all non-residents who are opting for presumptive taxation. Last year for NRs, there was a specific presumption scheme. Similarly, 44B, 44BB, 44BBB, these were also the sections for non-residents presumptive taxation like foreign going ship and foreign going aircraft. So those cases, there will not be any MAT applicability. However, for domestic companies, it is proposed that MAT would now be a final rate and no new MAT credit will be allowable because they are coming up to a 14% rate. And no set off of MAT credit means today when you pay the MAT, you compare with your normal tax liability. Assuming that MAT is higher than normal tax liability, then balance will be the MAT credit, which you will carry forward further. Now they are saying if we will compare in normal and MAT, your MAT is higher, MAT will be fine. They are also saying no set off of MAT credit if continuing in the old regime. And if you are already holding a MAT credit, they are saying that if you will continue in the old regime and you don't go into 22%, then in that case, we will not give you a MAT credit also. So this is surprising, but it is there. Set off of MAT credit if transitioning to the new regime during or after 26, 27. So they are trying to shift you into the new regime. And in such transition, the MAT credit would be allowable in such a manner. Set off will be restricted to 25% of normal tax liability. And balance credit can be carried forward to the subsequent year, subject to existing limit of 15 years and set off as well. So that is how the MAT related changes are there. Now, very interesting amendment I'm going to discuss with you. You all might have felt the heat of it, that employees' contribution to the specified fund is not covered under 43B. Or if it is covered under 43B, then the question comes that unless the contributions are paid up to the due date of 11 PF Act, ESI Act, the deduction will not be allowed. And there is a number of plethora of cases which have been there. Then there was retrospective amendment in 43B that the government said there is no intention to give you based on the due date of payment, based on 43B concept where you make the payment of such government dues prior to due date of filing return. Now what they are saying, at present employees contribution to specified fund, such as provident fund, employee state insurance, etc., are allowed as a deduction only if deposited within the statutory due date prescribed under the respective law. But it is being proposed to allow deduction of an employee's contribution if such contribution is deposited on or before the due date for filing the return of income, even where payment is not made within the statutory due date. This amendment will be applicable from the financial year 26-27 onwards. But I can say, since Satish ji is also there with us in today's session, when a prospective amendment takes place, to give some remedy to the assessee, why can't people like us try to avail the benefit of such prospective amendment in a retrospective manner? So when government today can do retrospective amendment, like say for example in Jao Fao issue, where government got defeated at various high court level, this year they have amended the law. And they have said, okay, Jao Fao, we don't agree. Whosoever has opened the case is valid. So these kind of amendment, when government can do retrospectively, why can't a retrospective interpretation can be developed by the assessee? That is what through this amendment I wish to put up before you. Now I come almost on the last part of my discussion, that if there are changes, yet there are important amendment in the TDS TCS rate. You all remember that 206C provide for TCS in certain cases, including where one person is making payment for overseas tour package. This is causing a dent to the assessee's pocket when he or she is booking overseas tour package. The rates are 5%, in certain cases it is even 20%. TCS rate will be then reduced to 2%. Similarly, when somebody is pursuing overseas education or somebody is going for medical purposes, medical treatment outside India, LRS related payments do take place, 5% TCS rate is there. Government is saying, okay, now we will have 2% only. Then comes TDS applicability on supply of manpower services, just to remove the scope of 194J in such kind of things. And to support the employment opportunities, government is saying, okay, there will be 1% in case of non-corporate, in case of individuals, and 2% in case of corporate or partnership firms in I. Then comes TDS on sale of property by NRI to become PAN-based. But this will become PAN-based effective 1st of October 2026. As you all know, presently what is happening, if the buyer is a resident but seller is a non-resident, buyer is supposed to first apply for 10 because he has to buy from a non-resident. You cannot follow 26 cubic kind of approach here. So buyer has to first go into 10 application, 10 is obtained, then buyer has to deduct, say for example, 12.5% plus surcharge plus cess if a real estate is being bought. And it is a cumbersome process. And this 10, once obtained, would be in his hands, then he will be thinking of surrendering the same also. So government is saying, okay, we will give you one window like 26 cubic. This is a welcome step. Then they are saying, okay, we are also coming up with the automation of lower tax deduction in the case of small taxpayers. So what will be this? Presently, you have to go into Form 13, but they are saying, okay, we will make the Form 13 procedure more easier, and this will help the small taxpayer to save their TDS and to enhance their, I can say, cash flow. One more amendment which is coming in this regard in the TDS is that the NSDL, CDSL kind of facilities, the platforms, can be approached by an assessee where you are holding the digitized format of a bond or a debenture. And once you give 15G, 15H to them, then that will operate for all the companies of which a bond or debenture is subscribed by you for the purpose of non-deduction of tax resource. So that also, in my opinion, a welcome step. So that is the TDS TCS related amendment which I discussed with you. And this is all, my dear friend, from my side regarding the amendments on the income tax portions. And if I miss something or if you want to ask me something, I am there more than.
Yes, sir.
Although if there is any other query
Yes,
from the
sir.
members.
Yes, sir. Sir, if a person is having income from profession and other sources but not liable for tax or other audits, she will file return on or before 31st August.
Yes, yes. This is the kind of option which is being given.
Okay, sir. Whether TDS new section is applicable for financial year 2025-26?
No, financial year 20. See, TDS provisions come from cutoff date. Okay. So we have to see, okay, what is the cutoff date? And from that cutoff date, this TCS relaxation would apply. Yet, one point which I would like to connect here, like when government is making a clarification that manpower supply services would be strictly covered under 194C, not 194J. So say this kind of amendment may be interpreted beneficially that where somebody is today making a payment to a manpower service provider company, then rather than deducting TDS under 194J, 194C kind of interpretation may be developed.
Okay, sir. Sir, one question is, as per company ESOP policy, certain number of shares has been allotted to employees. Some shares has been sold to pay tax perquisites and same has been disclosed in the Form 16. The shareholding has not been shown in Schedule FA. Will this scheme is applicable as on 31st March 2024 is less than 20 lakh and as on date the value of shares is more than 20 lakh?
Yes, yes. See, if the perquisite value of a share has already been offered, and many IT companies are allotting shares to their employees overseas. And I'm of the mind that they are also including that perquisite value for the purposes of preparing Form 16 of such person. So if that value has already been included in preparing Form 16 and tax compliance by this employee has been done accordingly, because TDS has been deducted on the perquisite component, in my opinion, the asset does not remain undisclosed. It is a different thing that in FA schedule such person has not reported it. So not reporting in FA schedule is there. But such kind of non-reporting of FA schedule, what kind of consequences it may attract? No negative consequence, in my opinion, prima facie. This window, which is being provided, is to those who have undisclosed foreign asset or undisclosed foreign income. Now, there is no undisclosed foreign income because perquisite value has already been covered in Form 16. If you say, department says it is an undisclosed foreign asset, then undisclosed foreign asset, the investment portion should also be in the nature of undisclosed, which is not so, because this person has not made any investment. Rather, he has been allotted a share either at a concessional price or free of cost. In the concessional price which he paid is out of his pocket. If that is the scenario, then how it goes to be an undisclosed foreign asset? So these kind of matter, in my opinion, still would be, even if not covered under the scheme, because the scheme would ask you to pay 30% tax extra. So why would one pay? Because he has already paid in Form 16.
Yes, sir.
In my opinion, such person would neither be covered under the scheme nor is otherwise liable to be covered under the undisclosed asset or undisclosed income scenario. But department may issue him a notice. Now here one may think that, okay, let me file ITRU. There I may disclose such asset. But ITRU ask for certain sacrifice in form of tax. So what will be that extra amount which you are going to disclose? That is an
Yes.
important question. I think that it is a matter which ultimately would get decided in the favor of assessee.
Okay, sir. Sir, no more further questions, sir.
Okay. So,
Okay, very nice deliberation by Anup sir. I
thank
think
you.
I have been benefited a lot. Like me, all the members present here in this webinar must have been benefited by his deliberations. So clarity, so depth, and just elaborating the history and thereafter the proposed changes and the impact also and how they can be beneficial for the members at large and or the assessee at large. Thank you very much, sir. Thanks a lot for
Thank you.
such a nice deliberations and Devendra Bhai also that you also deliberated a lot. So friends, I am just, I can say that I am extended chairman of this committee as of now because our last day was the 12th of February. But the Honorable President has extended the time limit that till he finalizes the new committee, you all people hold the charge. And that opportunity I got to invite Devendra Bhai and Anu Bhai that you come and these are the relevant things which you should share with the members. So, my dear friends, we did a lot of work in this committee in the preceding year, lot of changes, and but I'm really sorry that what I was visualizing that we could have brought this real-time attendance technology system this year, but we could not bring due to some permissions from the government side of that particular SIM binding process. But it is in the process, and I hope that new chairman or new committee will take up the issue, and by the end of March or in April, we will definitely bring that particular dream of mine, not only mine, but the entire profession, that we should allow the credit of CP on real-time basis. So we will definitely bring that particular new portal of the CP committee, and that will be a miraculous in the sense that if you don't have a time, don't get registered for that program. If you have time for attending that program, then only register for that program. So that will be a win-win situation for the organizer as well as the for attendees. So this was something which we could not do in this year, but we have a term of 4 years. 3 years are left. We will definitely be able to do that particular thing in within few 2-3 months. UAT is on and all things are going in smooth. Second thing, friends, just to remind you, union budget has rightly been taken up by Anup Bhai, and whatever suggestions you have in this union budget, which Anup Bhai has also given some directions that these are the things which should not have come, and this should have come like another. We are under the process of preparation of the suggestions to the government. You can also send us your suggestions so we can incorporate your suggestion in our suggestion that letter, and that can go to the CBDT as well as the government. Third thing, friends, profession has several challenges ahead because we were expecting the new company amendment bill which could not be brought as of now, but it's good thing that it is stayed for some time, but it is ultimately going to come, and where we can see that some limits in the audits of corporate entities, that is having some turnover limit. There is no need of the audit for the corporate entities, especially the small companies or the private limited company. So this we are working at the institute level that how we can stop that particular movement of the some of the part of the government. But still, I seek your help that whatever political connections you people have, just meet your MPs or MLAs or the ministers you have, and tell them why this audit is necessary for the profession or for the country at large. So this is my request for each of one of you who is attending this webinar. And last request I would like to make that kindly be in touch with the ICI, be in touch with the portal of the ICI, be in touch with the portal of the CMP of the ICI, where we have brought several benefits for our members. One or two I would like to tell you. We have made one tie-up with the AU Bank, where the credit card will entitle you 25% discount on the renewal membership fees payable to the ICI. So it can be a beneficial thing for the members if they love to have credit card. If they basically don't love to have credit card, they can take your own decision. We are not here to force you to take that credit card. Don't go at all if you don't love that. But it may be beneficial if you do even don't spend any money. If you don't spend anything from the credit cards, just pay the renewal fees of membership ICI through credit card and get that discount. And if you are the regular user of credit card, that is a wonderful initiation this committee has taken this year. Second thing, we have made one tie-up with the Tata 1mg, my dear friends, where Tata 1mg would give us 18% discount on the purchases of medicines and 50% discount on the booking of the diagnostic tests. So this arrangement we have made. So if you, I don't wish that anybody need of medicines or the diagnostic test, but if it is there in something mishappening is there, something by any reason you require those medicines or diagnostic test, please don't forget to have that particular in your mind, that whether you can have some benefits out of having booking through this CMP benefits portal. We have also made one arrangement with the cloud company that you will get the cloud space on a discounted rate. We have made arrangement with what very interesting thing I want to share with you members, that if you want to know about the crime record of your prospective client or existing client, so we have made one arrangement with some company. By simply entering the name, you would be in position to know the exact history of that particular person, that whether what he has in his back. So you can take a decision on the basis of that particular history, that how what precautions you must have in dealing with that particular client. So this we have done. This is very good arrangement we have done. We have also done one arrangement with CIBIL. If you want to check the CIBIL of your clients or your some non-person. So I think you are not able to do that at your PC or the laptop, but we have made that arrangement by paying a very small fees. You would be able to know the CIBIL score of your any person you want. So this thing we have done. And the purpose was this, that we should have all the facilities. Suppose you are dealing in the project financing and you want to check that whether that client has a good CIBIL score or not. So you, and not only loans, now CIBIL is being used in several other places. Just to see the financial record of the person, CIBIL is always used at several places. So this is all today, because it is already 6, and we had a wonderful session of Anup sir and Devendra sir, and we hope that this will continue, our process will continue in future also. So thank you, my dear friend. Thanks a lot. Thank you, Anu bhai again. Thank you, Devendra. Thank you, Raja,
Thank
who
you,
is
sir.
going to be chairman of the Jaipur branch. He
Thank you,
is
sir.
currently vice chairman. And on 24th, we are having a branch elections. I think he would be definitely promoted to the post of chairman. And again, he would be in position to do more service to the profession, more service to the fraternity. Thank you
Thank you,
very
sir.
much. Thanks a lot. All the best.
Thank
See
you,
you
sir.
again.
Thank you, sir.
Thank you so much,
Bye-bye.
sir.
Good night.
CP committee would like to thank both our faculties and, of course, Raja sir for an amazing session. Thank you.